Candlesticks. They look very simple, but they are super powerful. You learn the logic behind them, and if you learn to master them, you all can become absolutely amazing traders, and that's exactly what we are going to do in today's video. Hi all, welcome to the 23rd episode of the complete learning series of stock market investing and trading. As always, I've put all these learning videos into a series. The series is put into a playlist, and the playlist is available here in the I button up above. Make sure you watch all the videos in the right order and learn really well. Let's all trade together and grow together. So the agenda of today's video is super clear. We are going to learn everything that is there about candlesticks. We start from what is chart. Right, we have to first understand what charts are, then we'll understand why candlesticks are relevant. We'll understand what is a candlestick, what are different candlestick patterns, and what is the logic behind candlestick formation, which is super important. So yeah, without further ado, let's get right into the class. The name is Sharique Samsudheen. Welcome to Market Feed. So yeah, we've embarked on this journey to learn everything that is about trading, right? In the last video, we learned the introduction. We learned what all to learn so that we can become a really good trader. And in today's video, we are going to learn what is the most important, which is everything about candlesticks, right? So yeah, I hope you are as excited as me. Mark your attendance in the comment section. Let's get started, right? So as the title slide says, this is the candlestick master class that we are going to learn, right? So one thing which is very important is the fact that before learning what candlesticks are, how they are formed, what are the different type of candlesticks, we should actually learn why candlesticks. Why are they even required, right? So before getting into why candlesticks, we have to discuss about charts. What charts are, why charts are required, right? I hope all of you have seen a chart, right? At some point of your life, somewhere you would have seen a chart. Have you ever asked this question to yourself? Why price is shown as charts? Right? That's exactly what we'll learn about in the very first slide. So getting into that. So the question is, what is a chart and why is it used? So in the last video, when we learned about technical analysis, what was the basic definition of technical analysis? Technical analysis says that we can predict the future movement of a stock by analyzing the previous price movement and previous volume movement, right? What is it again? We can predict the future movement of a stock by analyzing the previous movement of the stock. Now, what do we have to do here? Analyze the previous movement of the stock. How can we analyze the previous movement of the stock? Only if there is a chart. Correct. What if there is a chart? You think about that. What if there is no chart available? Say a stock for the last 10 years, it has been moving at different price movements. How would you know what was the previous price movements? What was the previous price patterns? You'll never know, right? So if you look here, what was the old method available before charts coming into existence? Keep watching a screen and try to remember. What that is, keep watching the prices on a screen and then try to remember what all happened at what all price movements. Is it even practical? Think about it. You do not have chart system available, which we luckily have today. And all you have to do is you have to remember Nifty's levels at every single second for the last 10 years. Is it even practical? Never, right? And that's exactly where charts came into existence. So what is the new method, which is the chart method? That is visualizing price movements in a chart form. So people that time thought, okay, so one thing what is necessary is we have to see the previous price movements, then do some analysis so that we can predict the future price movements. So we have to see the previous price movements. So let us take price data from each and every second and plot it on a graph. And when we plot it on a graph, we can visualize it. And when we visualize it, we can easily form analysis and then do technical analysis and then predict future price movements. Understand? And that's exactly why charts came into existence, right? So again, just revising this, the original question was, what is the best method to visualize price movement of a stock or a security? right? Charts came into existence so that we could visualize the price movement of a stock or security. And why do we visualize? We can visualize so that we can do technical analysis, and thus we can predict the future movement. And when we predict the future movement, we can take good trades and make good money, right? I hope things are super clear, right? So charts help us understand patterns in price movements very easily. Now let's move ahead and see Tata Motors 6-month line chart. Now, when we speak about charts, there are multiple types of charts, but let's talk about the most basic type of chart, which actually came into existence for the very first time. When people felt that, okay, prices shouldn't be just mentioned on a piece of paper, it should be visualized into a chart. The very first natural form of chart was called a line chart. And now you look at this. This is the last 6 months price movement of Tata Motors. Right, you get to at least visualize something, you get to see something very clearly, right? So if you see, in March, which is nearly 6 months before, price was nearly 490 here. If you see here, on the y-axis, we have the price going, and on the x-axis, we have the time. That is from March, April, May, June. You can see at different points of time, what was the price of Tata Motors, right? On the y-axis, we have the price of Tata Motors. So if you see, in the last March, just before March, the price was way above at nearly 490-500 rupees. Then it came crashing down from February to March all the way down till 390. Some 100 points fall happened here. Then it took support here. Now, support is a term that we will learn going ahead, right? Tata Motors price from March moved up, and if you look here in April, the price moved up to nearly 460 rupees. Then it came down again by May. It came down all the way till 380 rupees, then went up till 440. By June, mid-June, right? Mid-June, it was back at 390 again. Then it had a wonderful rally. By August mid, it went back to 490 again, and then it came down. Basically, you get the point, right? You get to analyze the price movement. How? Only because we had a chart here. Right? I'm going back. What is a chart? We get to visualize price movement. And that's exactly what we are doing here, right? We are visualizing the price movement. Why? Because we can it helps us understand patterns in price movement easier. Now you can easily look into it and you can analyze patterns. You can do your technical analysis. You can put technical indicators, all of which we will be learning in the coming episodes. Now you understand that charts are super important. You understand what charts are, why they were invented, and line charts were the first form of charts. So humans, yes, they invented line charts and those were the very first form of charts. But line charts weren't completely telling everything regarding the price movement of a stock. There were some shortfalls or shortcomings when it came to line charts. That is where the Japanese found a better way. Japanese, way back, Japanese came with a better form of visualizing price movement of a stock or a security or a commodity on screen. Japanese came with this way. And what is that way? That is called candlesticks, right? The Japanese way of visualizing price of a stock or a commodity or a security on screen or on paper in the best possible manner. Yes, that is what we are going to learn now. So if you ask me what candlesticks are, my answer to you is candlesticks are the best form of visualizing price movement of a stock, right? See, we came into learning about charts in order to visualize the price movement of stock, and the best way to do that is candlesticks. No questions asked. Because if you just look at something like this, I know a lot of you have already seen candlesticks, but if you actually learn well about candlesticks, the candlesticks actually talk a lot about the price movement. They actually tell a lot of stories. You just have to understand the stories that they are telling you. If you understand those stories well, you can definitely become a good trader. So if you simply read this, you can easily understand that a candle, right, candlestick or a candle shows price movement in a fixed time period very efficiently by showing open, high, low and close price. That is just one candlestick. If you see here, just one candlestick gives you 4 data points and a lot of stories. That is the catch there. 4 different data points and a story regarding the price action also just by looking into a single candlestick. And so what are the different 4 data points that you'll get? See, a candlestick represents price movement in a fixed time interval. A candlestick can either represent 5-minute time interval or 10-minute time interval or 15 minutes time interval, a day time interval, a week time interval, a month's time interval, and it goes on like that, right? So in that time interval, what was the opening price of the stock in that time interval? What was the low created in that time interval? What was the high created during that time interval? And at the end of the time interval, where did the price close? Everything is conveyed just with a single candle. And that's exactly why candles are super efficient and the best form of visualizing price movement of a stock. And what is the story that a candle tells? Now, if you look at this candle, you can understand what is the story. Try to understand the story. Try to get a feel of it, right? And that's where candles are going to be super important in your trading journey. So if you look at this candle, yes, we have 4 data points here. Plus, what is the story? The story tells that the candle opened at a lower price. Then it moved up probably. Then during this time interval, it came down. It created a low. At this point, the price actually moved down. Then it probably went up, created a high of so much. And then it came down after that and closed somewhere over here. So there is a story, right? So the story basically tells that in this time interval, the price actually moved up. And in the course of moving up, it actually went down also a bit and created a low. And it also went to a point higher than the point where it closed also. So much story is being spoken by this candle also. So one simple story is, yes, there was buying happening in the market or happening in this security or commodity we are looking at within this time interval. Now, if you look here, you can see that there are 2 different types of candles. A green candle, which is a bullish candle, and a red candle, which is a bearish candle. Now, no worries, there is a complete slide dedicated to learn about bullish and bearish candle. So we'll get to that. Before going into that, we should understand the structure of a candle, right? There are certain terminologies used in the industry, so let us learn them. So if you look into this candle, and if you read here, you can easily understand this, right? The first thing we should understand is the central real body, which is this one, right? This is called the real body of a candle. It is rectangular in shape and it connects the opening and closing price. Now let's put an example here, right? Say this is a 5-minute candle, or it is a candlestick which represents price movement of a stock in a 5-minute time interval. And let's assume that in a 5-minute time interval, the stock moved from 100 rupees to 110 rupees. It opened at 100 rupees at the beginning of the 5 minutes, then it closed at 110 rupees after 5 minutes. In between, it created a low of 95 and it had actually went up to 115 also. But it opened at 100 and closed at 110. If that is the case, this is how the candle would look like. And the opening would depict 100 rupees here. The low would show 95 rupees. Close would be 100 rupees and 110 rupees. And the high would actually show 115 rupees. Now, what connects the open and close is a rectangular shape here, right? And if the close is higher than the open, it would be a green rectangular shape, and that is called the real body, or let's simply call the body of the candle. Cool. Now, as you can see here, up top and down below, there are wicks or these lines here, right? Those are either called shadow or wick. The one on the top is obviously called upper shadow or upper wick. The one at the bottom is called a lower shadow or lower wick. As you can see here, upper shadow or wick, it indicates the high. From the close to high is called the upper shadow or wick, or from the open to low is called the lower shadow or wick. So one thing you have to understand before moving ahead is the fact that a candle actually keeps moving real time. So as you can see here, it just keeps moving, right? So when we speak about a 5-minute time interval, it is not like after 5 minutes, a candle is just formed like that. No, it just keeps moving every second. As the price moves, the candle actually keeps moving. And at the end of the 5 minutes, the final form of the candle is formed. And the final form of the candle can be basically 2 types, right? Either it can be a bullish candle or it can be a bearish candle. And that's what we are going to learn next. So first, let's learn about a bullish candle. And what you see here, this green candle is what is a bullish candle. This red candle, what you see here is a bearish candle. So it's actually very simple. There's only one difference. A green candle or a bullish candle means that the close price is more than the open price. Which means that in whatever time frame that we are analyzing, the price actually opened lower and there was buying happening in the market and the commodity or the stock closed higher. Buying happened in the market. Only if buying happened in the market, the close price will be more than the opening price. Very simple, right? And that is what a bullish candlestick. Let's read it here. It is green in color and it represents buying. Number 2 is close will be higher than the open, which means that price increased in that time frame. Very simple. A bearish candlestick or a red candle is just the opposite of that. As you can see here, the close is lower and the open is here. So the price opened at a higher price, then it probably moved up, then it came down, created a low, and then it closed at a price lower than the opening price. An example here might be, maybe it opened at 110 rupees, it went up to 115 rupees, came down to 95 and closed at 100 rupees. So 100 is lower than the opening of 110. Correct. So that's exactly what a bearish candlestick or a red candle is, right? So yeah, it is red in color and it represents selling in the market. Obviously, right? There was selling happening in the market. That is why a stock which opened at 110 came down to 100. So a red candle or bearish candle means that selling is happening in the market. People are interested in selling and not buying that specific commodity or stock. So the next point here is close will be lower than the opening price, right? Close is lower than the open. So price is decreasing. So if you actually look at this, it's very simple, right? If you look at a candlestick, it gives you 4 different data points. That is, on the y-axis, you have price. So those are the 4 different data points that you'll get. And it also gives you a story regarding whether buying happened in that stock or selling happened in that stock during that time period. Now what we can actually do is some practical learning. Let's come into TradingView, which is an absolutely amazing tool that we can use to view and look at charts, right? Now if you come to TradingView, I have selected Nifty here. I'm looking into the chart of Nifty. And what do you see here? You see candlesticks, right? And what time interval is this? See, I can select the time interval here. I've selected a time interval of 5 minutes. Now I see. Now each candlestick represents 5 minutes of price movement in Nifty. Correct? So what time does the market open? 9:15 a.m. right? Now I'm looking here. See, as you can see here down below, the date is 25th October, right? On 25th October, I'm keeping. So you can look at the thing here at the bottom here. So if you see here at 9:15 a.m., the very first 5-minute move is depicted by this single candle. That is from 9:15 a.m. to 9:20 a.m. What happened to the price movement is shown by this single candle here. I'll move the chart a bit so that we can see even more clearly. So next I want you to look here. Okay, look into this data. What is this? OHLC. Open, high, low and close. These are the 4 data points one candle will tell you, right? Now we have the first 5-minute candle, or this is the candle which depicts the price movement from 9:15 a.m. to 9:20 a.m. 5 minutes, because I selected 5 minutes here, right? So I'm keeping my cursor here and you have to observe here. Okay, read the data here. I'm just going to keep it here. What is the open at that point of time? Opening of Nifty at 9:15 was 17,811, and in this time period the high is also 17,811.5, and it is shown by the candle also, right? I'll make the candle even more clear. There is no upper wick. No upper wick means that the open and the high is also the same. Right? Candlestick is speaking to you. You can easily understand. Then what happened? It came down. It created a very low low, but it went up a bit and then it closed somewhere around here. So the low will be even lower than the close. Let's look here. Low is 17,717. I hope you're looking at the right place, right? The low is 17,717.55 and the close is 17,741.3. So it went down so much, then it came back up a bit and closed at 17,741. Candlestick giving you important 4 data points and speaking to you as to huge selling happening here, right? It opened at 17,811. A lot of people selling, hammered Nifty down all the way till 17,700 ranges. Very clear. Now what I can do is I can come here, I can change the time interval to say 15 minutes, right? So it will change. Now what you see on screen is 15-minute candlesticks, which means that candlestick which represents the price movement of Nifty over a time period of 15 minutes, right? So again, now the first candle, if you see, it depicts price movement of Nifty from 9:15 a.m. to the next 15 minutes, which is till 9:30 a.m. right? So if you look here again, if you keep here, or let's go to some other candle, right? Let's take this candle for an example. As you can see here at the down bottom, I hope there is a circle which is coming there. Now that is a candle at 10:15 a.m. which means that that candle depicts the price movement of Nifty from 10:15 a.m. till 10:30 a.m. Let's look into the open, or even before looking into that, let's see, right? Let's see if you have understood this. The price opened somewhere around here. Then there is a small wick, right? A small wick means it moved up a bit. Then it moved down so much. Then it came back up a bit and closed here, right? And that's exactly what the OHLC data is saying. If you read there, you can see open is at 17,757, high is 17,758, just 1 point up. Then it came back down all the way to 17,707 and closed at 17,714. A 15-minute candle or a candlestick which represents the price movement of Nifty over a time period of 15 minutes, right? Just like this, you can change the time period here, right? I'm clicking on daily candle now so that it will show us the price movement of Nifty over every single day. Now, if you see here, if I keep the mouse cursor, say, on this day, this is a very good green bullish candle like we just learned. So that is from the day of 30th September. So this single green candle here, if you see, this green candle I'm talking about, it shows the price movement of Nifty on 30th September. As you can see here, without looking into OHLC data itself, now you can tell the story of what happened that day, right? What did happen that day? The price opened lower than the previous day. Right, the previous day there was massive selling in the market. Nifty came down from nearly 17,000. It came down. I'm looking at here, right? The right side. I'm looking for the price. I hope when post production is done, there would be a circle put there. It came down all the way to 16,810, and the next day, in fact, if you see, it opened even further down at 16,795 range. Then it went down a bit. See, it went down a bit. Then came superb buying in the market. Superb buying. Nifty came so much above, so much till here. Then it came down a bit and closed here. Right? We get a story. On 30th September, Nifty opened lower than the previous day because the previous day closed where? Closed here, right? It is a red candle, closed as the lower part of the body. So the next day, Nifty opened lower, went further down, then came amazing buying in the market, then came down a bit and closed here. Very clear. Now, this is why I said candlesticks are the best way to depict the price movement of a stock or a security over a time period. It gives us 4 important data points. It tells us a story as to what sort of a buying or selling happened over that time period, right? Super clear. Now, if you have understood so much, understood the emotion, the story which is attached to candlesticks, then let's understand a bit more different types of candlesticks, right? Because these are the two basic different types, bullish green candle or a bearish red candle. But as you saw when we went into trading, you saw different candles have different forms and different shapes. Some has a wick, some doesn't have a wick, some has a very large body, some has a short body. So depending on what sorts of wicks and bodies different candles have, there are different candlestick types, and that is what we'll learn next, and that's the last agenda of the video as well. Different types of candlesticks based on the shape and form of their body and wicks. Cool. So if you see here, there are multiple types. The first one is called a Marubozu. Now, never be intimidated by these complex names of different types of candlesticks, right? And I've seen a lot of beginners getting into the vibe of, hey, I have to by heart all the different types of candlesticks. Now, let me tell you, you need not learn these complex names. You need not by heart the technicalities or the theory part of this. All you have to understand is look at the candlestick and understand the story that the candlestick is telling you. I've been saying this from the beginning, right? Candlestick speaks to you. You just have to understand the story. If you understand the story, then you don't have to know the names. To be very honest, if you actually ask me what is a spinning top or what is a different type of a candlestick, I might not be able to say. But by looking at a candle, I would be able to say, okay, this candle depicts this, so there is a chance that so and so thing can happen in the next candle. I can tell that, right? That is the level you have to reach. Cool. But anyways, we are learning the theory. So let's learn the theory a bit. But whenever we are learning theory, I'll be telling what the candlestick is speaking to you as well. You have to focus on that more and not focus on getting intimidated by the theory of it. Cool. So yeah, types of candlesticks. Number one is Marubozu. Then we learn about spinning tops. Then we learn about dojis. Then we learn about paper umbrella. And finally, we learn about shooting star. Cool. We'll quickly do this. So the very first type of candlestick we are going to learn is Marubozu. Now, Marubozu is a type of candlestick which is very easy to understand, very easy to learn also, right? So we can learn it theoretically. We can also learn the story that the Marubozu is telling us. So let us focus on the story first. So if you see here, there can be a bullish Marubozu or a bearish Marubozu. You can easily tell what that is. A bullish Marubozu is when the close is higher than the open. A bearish Marubozu is when the close price is lower than the opening price. That is, the stock opened higher and then it moved down. Right. Now, if you look at the candle itself, you can understand the story. What is the story? What can you see here? There are no upper wicks or there are no lower wicks. Let us focus on the bullish Marubozu. What does not having wicks mean? Think about it. Not having wicks probably mean that the stock, I'm just taking an example, it opened at 100 rupees. It did not move down a single rupee. It just kept going up and up and up and up and up and up. And at one point, it did not create a high and that it did not come down and close. It closed right at the high itself. What does it mean? What is the story there? The story tells that right from the opening, there was only relentless buying in the stock, right? At no point there was selling. If there was selling, it would have probably moved down and created a low, thereby creating a lower wick. Or if there was selling, it would have moved up a bit, then it would have come down a bit. With that selling, it would have come down a bit, thereby creating an upper wick. Did it happen? No, right? So a bullish Marubozu means that the story tells that there was only buying throughout that time period. Only buying, no selling at all. What does it mean? Super bullishness, right? And that's exactly the exactly opposite is what we can understand in a bearish Marubozu. There was only selling, 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 selling. Thereby, there is no upper wick and there is no lower wick. Clear? Now let us read the theory. You will understand it, right? A candlestick with no upper or lower wicks indicating strong trend. Now you understand where you can get confused. A lot of people, beginners, have seen that they try to just by heart the theory of this. Okay, Marubozu is the candlestick with no upper or lower wicks indicating strong trend. Do you need to do that is my question. You need not know the name Marubozu. You need not know this theoretical definition. Forget all those. Understand the fact that if you see such a candlestick forming on your chart when you are trading, you just understand the fact that, okay, there is strong buying happening in the market. Don't even know whether the name of the candle is Marubozu or something else. You get my vibe? That is how we should learn is what I believe. Cool. Anyway, so candlestick with no upper or lower wicks indicating strong trend. So a bullish Marubozu means that open is equal to low and close is equal to high. Do you need to buy hard this? Again, absolutely no, right? So it is a clean buying candle, started moving up from opening level and closed at the highest point. Bearish Marubozu means that open is equal to high and close is equal to low. Clean selling candle started moving down from open and closed at the lowest point. Simple. You have understood the story. You have understood the theory as well. Now I want to ask you, by looking at say a bearish Marubozu, what do you make of it? What analysis can you do? Simple analysis. A simple analysis can be, if a bearish Marubozu is formed, it means that there is a strong downtrend. People are only selling, selling, selling. Then my question to you is, then say this is a bearish Marubozu in a 5-minute time frame, which is on a 5-minute time interval, you find a bearish Marubozu. My question to you is, what can be a high probability for the next candle? What can probably happen? Will the price move down from there or will the price move up from there? Where is the probability more? Simple answer, right? Because there was so much selling, clear selling. It is a Marubozu, right? Clear selling in this candle. There is a higher probability that in the next 5 minutes or in the next coming time also, the stock price can move down a bit. I'm not telling it will definitely happen. I'm just saying there is a higher probability that selling can continue because there was so much selling which just happened. So the selling can continue. Logical, right? Let us see that for an example. Now, my point there is, see, different types of candles, different forms and shapes, and Marubozu, a spinning top, all of those are for you to analyze. Because these candlesticks talk to you. You take that story, you form an analysis, you form a high probability analysis for the next candle based on which you can take a trade. So my point is, if there is a bearish Marubozu, you can probably short the stock or short the security there. You can sell it there and you can make profit because there is a high probability that the stock can move down further. Got it? So I'm coming into an example here. This is ICICI's 5-minute charts. I've taken as an example. You can see a near Marubozu here, right? It is a bearish Marubozu. I know if you closely look, there are very small wicks. But again, Don't focus. That is where theoretical people will go wrong. They will say that there is a small wick at the top, a small wick at the bottom. Is that a Marubozu? I mean, don't even give a fuck to that, right? What matters is you see here, it is clear selling. That is what the candle is speaking to you. Hey, there is clear selling happening in the market. And what happened? What can you see in the following candles? The selling just continued. What if you would have sold it here? Short sell it here. You would have made good money, right? That is why different candlesticks are important. You have to understand what stories they are telling to you. And based on that, you have to form an analysis. And based on that, you have to take a trade. Clear? If that is the case, see, we have a bullish Marubozu also here. See, it is actually a proper bullish Marubozu without wicks at the top or the bottom, right? And what happened after that? See, buying continuing. If you would have bought it here at nearly what, 863 rupees, you could have sold it for what, 867, and that's good money, right? Cool. So anyways, that is Marubozu for you, which is the first type of candlestick we were supposed to learn. The next one, as you can see here, which we have to learn is a spinning top. Okay. Now, when we are learning a spinning top, I don't want to get into the theory at all. Let's just look into the candle and let's see what story the candle has to tell us. Can you do that? You can pause the video. You can just look at the candle and you can try to form an analysis in your mind. Try to listen to the candle and see if you can understand the story that the candle is telling you. Can you? Take it as a challenge. Try doing that. No. So a spinning top, if you see here, again, you need not focus on the name, but still, a spinning top, if you see here, what can you understand? There is a small body here and very large wick on the upper side and a very large wick on the lower side as well. And there is a bullish spinning top and a bearish spinning top also based on where the close and open are. So what is it that you understand here? Wicks are very large on the upper and the lower side and there is a very small body. What does it mean? It simply means that there isn't large buying happening in the market and there isn't large selling happening in the market, which means that traders or market participants are not clear as to what will happen to the stock in the coming time. That is, a spinning top basically says that there is indecision in the market. There isn't clear buying or there isn't clear selling also. So there is indecision. So we are not clear as to what can be the trend going ahead. Cool. So now if you read the theory also, you'll understand a bit more. A spinning top indicates indecision, consolidation, or even trend reversal. You read more, you'll understand more. So anyways, if you understand about the candle, that's what is written here. Candles have small real body and almost equal upper and lower wicks. Very large upper and lower wicks, and color of the body does not matter as it is small. Right. Now, this is a very important point, right? So looking at a green spinning top, you need not say that it is a bullish spinning top. Looking at a red spinning top, you need not say that it is a bearish spinning top. Why? Because the real body is so small. There isn't clear buying and there isn't clear selling. So, because the body is so small, the color does not really matter, which is a very important point as you can see here. Now, again, if you see a spinning top on your chart, it depends on where it is being formed. So, as you can see here, if a spinning top is formed in a downtrend. Now, don't read that. Just focus on this, right? If a spinning top is formed in after a downtrend, what does it mean? What does a downtrend mean? People are selling. Then a spinning top is formed. What is the meaning? The sellers do not want to sell a lot more. And the buyers also are not buying a lot there. So what does it mean? The downtrend probably has stopped or has paused, or there can be a trend reversal. You understand the story? There was a downtrend, which means that a lot of selling was happening. All of a sudden, there is a spinning top, which means that the sellers are not interested in selling anymore. So it means that there can be either consolidation here. Then we need a candlestick which can tell us, okay, now maybe the trend has reversed or the trend is continuing on the lower side, right? Spinning top in downtrend signals sellers are getting tired, possible reversal or consolidation. Simple. Just like that, spinning top in an uptrend means that there was a lot of buying happening in the market. All of a sudden, spinning top comes, which means that buyers are not buying anymore. Which means that there can be consolidation there, after which there can either be a trend reversal or maybe the trend even continues. Very simple. Now let's see a spinning top in action here. So if you see here, there was a slight downtrend here. Price is kind of moving down. Then multiple spinning tops here, right? Which means what? consolidation. The first spinning top is formed here. Now if you go theoretical, you can say that something's mentioned here, right? Almost equal upper and lower wicks. You need not be so focused on that is what I think, right? So here again, a very small body is what you can see, and there are wicks on both direction, and there is indecision, right? Price isn't moving anywhere. It came down. It isn't either moving down or it isn't either moving up also, for multiple candles just staying there, and finally there is a trend reversal also happening. Cool? Understood? If that's the case, now let us understand the next candle type, which is a doji. Now doji, as you can see, is very similar to spinning top, but it has no real body at all, right? Doji, I would say, a spinning top on steroid. As to there is absolute indecision. There is no body at all. The open and the close is exactly at the same price, but there is a very high upper wick and there is a large lower wick also. Now, depending on where the body is, which is just a single line, because that is what a doji is, right? Doji wouldn't have a body at all because the open and the close are exactly at the same price. There wouldn't be a green or a red body. There would just be a black horizontal line just like this. Now, depending on where the horizontal line body is and what types of wicks they have, there are different types of doji also. Doji star, long leg doji, dragonfly doji, and gravestone doji. Let's not focus a lot on this. What do we understand from a doji? What do we understand? There is no real body at all. Open and close are at the exact same price, but there are wicks on both sides or wicks on single side. It again means that there is indecision in the market, right? Indicates extreme indecision and trend reversal probably. Trend reversal is not a confirmation. It would depend on what other candlesticks are formed after a doji, but doji indicates indecision. People in the market. I mean, try to understand the story, right? Traders are not sure whether to buy there or sell there. What does it mean? Indecision, right? As simple as that. Now let's come into an example. Let's see doji in action. See, if you see here, the price was moving up and up and up, and then a doji is formed here. See, a doji is formed here. Then a different candle is formed. Then a doji is formed. So here also you can see multiple dojis are formed. So when dojis are formed, it is better not to trade at all, right? Because there is indecision in the market. We will take a trade only when there is a clear indication of a trend, or a clear indication of taking a trade. Doji says there is indecision, so better not take a trade, right? For example, if you look at a Marubozu forming in the chart, it is a good indication that if it is a bearish Marubozu, there is a chance that the stock can move further in the coming time frame. It is a good indication to sell the stock, right? Just like that, a spinning top is not an indication to take a trade. A spinning top is an indication that a trend has kind of stopped. So spinning top can probably indicate that maybe you can exit a trade. Think about a bearish Marubozu forming in the chart. Then you short sell, you do short selling in the stock, you are in a short position. The stock is moving down. Then a spinning top formed. You can exit the stock there, no? So spinning top is a good exit indicator. It is not a good entry indicator, I would say. After a spinning top, then if there is a bullish Marubozu, what will you do? Then you can probably exit from the previous short position. Then you can enter into a new long position. I hope you're getting things clear. It's all about understanding what the candles are telling you and then taking an action on top of that. So based on that, I would say doji is not something that, or if you're already in a position, you see a doji, you can probably exit your position. But doji, when you see a doji, it's not a good time to enter a new position. The next candlestick type that we are going to learn is one which I like a lot, which is a hammer. A hammer. So if you look at the structure of a hammer here, you can understand a lot about what it is telling you. So if you see here, there is a small body at the top and there is a large wick at the bottom. What is the story? Simple question to you. What is the story it is telling you? The stock price probably opened here, then it moved down a lot. That is what the wick says, right? It moved down a lot. And then there was so much buying in the stock that from that low, it moved back up and up and up. It broke the open again, it went back up, and then it closed at the high. It closed at the high, which says that there is strong buying from the bottom which happened, and then it closed at the high. Closing at the high is a good indication. Just like we saw it in a bullish Marubozu, right? Close is at the high, which is even at the very last moment of that time period, there was buying happening in the market. So this says that there was some weakness, but then buyers were activated so much to an extent that there was so much buying back up, and it closed at the high. What does it mean? There is If there was a downtrend, it is stopping. Buyers got activated. Now a good buying is going to happen in the market. Correct. Now, if you read here, you'll get more clarity. A hammer is formed at the bottom of a downward rally and it indicates trend reversal to bullish. Now, this is kind of similar to your spinning top, right? We learned about a spinning top. At the end of a downward rally, if there is a spinning top, it doesn't mean a trend reversal. It kind of means that the downward rally has kind of stopped. Correct? Now, at the end of a downward rally, if there is a hammer, it means that it is not indecision. It means that the downward rally has stopped. Probably the stock can move back up now. Why? Because it is not indecision. There is a clear, because in a spinning top, there was indecision as to whether buying or selling is happening in the market. But if you look at a hammer, you can clearly see that buyers are winning over the sellers. That is why even after creating a low, there was so much buying over sellers that the price moved back up and it closed at the high of that time period, right? So it is indicated by a small upper real body and a long lower wick. Length of lower wick should be around twice as much as length of real body, and color of body does not really matter. It can even be a red candle. It is fine because there is a long wick, which means that it went down. Then a lot of buyers got activated. Buyers bought at a higher price, and that is why a long wick is formed at the lower side, right? And if you see here, there was a downtrend. The stock was coming down, and then here is a hammer being formed with a very long lower wick. There is a hammer, and see, the trend has reversed. Very clear. Just focus. No, don't even focus on the name again. Not on the theory, just on the story that the candlestick is saying you, which is there is a long lower wick which says that went down, buyers got activated, so much relentless buying which took the price back up. Right? Tells the story. So if you look here, hammer in action, if you see here, there was a downtrend. And if you see here, even after this long red candle, see, there's a discrepancy. We'll talk about that also. Anyways, a long red candle, and this is a proper hammer. As you can see, there is a long lower wick and there is a small upper body, and see, proper reversal happening. Now, the discrepancy I'm talking about is here. See, if you look at this long, large red candle, that is a bearish Marubozu. So after a bearish Marubozu, we know that there is a high probability that the stock can move down further. So a lot of you might actually short sell the stock here. So as you can see here, it is not like you switch on a light and the light has switched on. Technical analysis and candlestick analysis is not as 0 and 1 like that. So you can only work on high probability setup, and you should have a clear SL plan also, right? So you could have actually do short selling in the stock here, but then after seeing that, okay, a follow-up red candle has not formed, a hammer has formed here, you could have probably exited the stock also there. Thereby you are making only a small loss. Wherein, if there was a large downtrend continuing, you could have made a large profit also. You understand? That is where candlestick analysis is super important. Seeing this, you could have exited the original short position, and seeing this, you could have actually gone long here also. Then you could have made very good profits also. You cut short in your short selling position, a very small loss, and then seeing the hammer and a follow-up to the hammer, you take a long position, you could have made a large money. See, small loss and a huge profit. Simple. So that is where I say candlestick analysis or technical analysis, the technical indicators that we are going to learn are also not going to give you the superpower of being able to exactly predict the market. No one is going to be able to absolutely predict the market in a very right manner 100% of time. All you can do is have high probability setup. You can have a high probability analysis that, okay, there is a high probability that there can be a follow-up red candle. And you could have made money if there was a follow-up red candle, or you could exit with other analysis as well. So it's all about having high probability setups. So if you understood hammer, then let's understand another candlestick type which I like a lot, which is a shooting star. So if you look at a shooting star, again, if you don't read the theory, if you just look at the image here, you can easily understand what the shooting star is telling you, right? What is it telling you? Because there is a long, large wick at the top. What does it mean? The price probably went up. Sellers got activated. There was so much selling which happened in the stock. The price came down so much, right? And that is what a shooting star is, right? So it indicates ending of bullishness at the top of a rally. It is just the opposite that of a hammer. Hammer indicated the ending of a downward rally and indicated that, okay, there would be a trend reversal. Just like that, shooting star would come at the end of an upward rally and it would indicate that, okay, now because there is a long wick at the top, now sellers have gotten activated. Now the stock price can probably move down. You can exit your existing long position or you can initiate a fresh short position. Logical? Now let's read the theory. Indicates ending of bullishness at the top of a rally, small lower body and long upper wick. Longer the wick, more the bearishness. Right? In a hammer, longer the lower wick, larger the bullishness. In a shooting star, longer the upper wick, more the bearishness. Color does not matter, but more reliable if it is a red candle. Very clear. Right? Color does not matter, but it is more reliable if it is a red candle. Just like that in hammer, color of a body does not really matter, but it is more reliable if it is a green candle. Correct? So it's all about just understanding the logic as to what is the candle talking to you. If you understand that, then you have cracked that secret sauce of becoming a good trader, right? Now, if you see shooting star in action as, if you see here, don't even focus on shooting star, right? You see what's happening here. Good buying happening in this candle. Good buying happening in this candle also. Good buying happening in this candle also. Now look at this candle. Forget it's a shooting star, forget everything. So buying happening, and then the price went up so much, then it came down. What does this wick indicate? This wick indicate that the power or the buying power is reduced. Sellers got activated here. The buyers are not powerful anymore and the price has come down here. What does it indicate? It's a shooting star. Buyers are not powerful anymore. Sellers have come into the scene. Probable trend reversal. And what has happened eventually? Price came down, right? So that is what a shooting star tells you. Now we have kind of come to the end of the session, and that is exactly, or this is exactly how I would love to end the session, which is understand candlesticks with your heart, and then you won't need names. And that's the exact point I've been re-establishing throughout the learning session, right? I never wanted to focus a lot on the theory or on the name of different types of candlesticks. It's all about understanding what the candlestick is telling you. Take it to your heart. Listen to candlestick. When a candlestick is being formed, understand what it is telling you, showing you. If you start understanding that, then you will become a great, amazing trader, and wishing you all the very best for that. So yeah, that is it from my side for in this video. Make sure you smash the like button, you get into the comment box, ask me doubts, join my exclusive private community that I run on MarketFeed app. The link to join the community is given in the description and in the pinned comment down below. So yeah, we are on the journey to crack trading, intraday trading, futures and options trading. So I hope you are with me in this journey. Share the video with maximum people. Invite them also to join our amazing journey here. Let's make sure all of us, or at least a lot of us, become amazing great traders. Be with me in this journey. We'll make sure that we do this, right? So again, the coming video is also super interesting because in this video, we learned single candlestick patterns. Now, if there are multiple candles coming together, those actually talk even more to you. We have to listen to multiple candlesticks and we have to form analysis. That is what we learn in the next video. We'll definitely see then. So as always, let's learn, trade, invest and grow together. See you in the next class. Bye-bye.